Done. It's going. Right. And we are live on YouTube as well now. So let me share my screen. Let's go. Did I give any assignments last week? With the performance evaluation, will it be solving of questions live? Yes, sir. We'll be solving the question. Hey, yes, ma. Rose. We'll be solving a question live. So the way it's going to go is that you're going to be having access to the question just the time that we are going to do the test. Then we're going to have, if it is a 1 hour, for you to do the tests with your cameras being on, so I can see your face if you are cheating and I can monitor you all. So Rose, that's how it's going to be. It's going to be a live practice question there. Okay, let's go. Let me share my screen and let's go. Last week, I didn't give you any assignments, right? So let's jump straight up into our discussion and let's see what we can do. My screen is coming up. Let's see. Okay, there we go. So last week we were on investment appraisal, sharing our thoughts on the various things, actually the theoretical aspect of investment appraisal. We've dealt with it. And then we spent time to look at the question on pink score. You saw the way the treatments were made in the context of pink score there. And so we're going to be building up on that today and look at it. So the question we were looking at last week was pink score. Now, because NPV has relationship with IRR, I'm going to be starting off my discussion today with internal rate of return, so that the question that we solved last week, we will use the principle to solve or to calculate the IRR for the for pink score as well, using the nominal cost of capital or the nominal cash flow. Are you okay? So let's go to our slide. You have this document already, the investment appraisal document, which we shared with you last week. So we want to go into internal rate of return and then take our discussion from there today, internal rate of return, and take our discussion from there. Now, aside the NPV, that is the net present value, which we saw the various issue that has to be taken into consideration. Another method that we can use to evaluate the viability of the project is what we refer to as the internal rate of return. The internal rate of return. Remember, like I told you last week, it is the same as the break-even rate. So should the examiner ask you, calculate the break-even rate, note that it is the same as the internal rate of return. If the examiner asks you, calculate the break-even rate, note that it is the same as the internal rate of return. Now, what is this rate about generally? The idea is that the cash inflows from the project or from a given project would have to be reinvested by the company in order to maximize the wealth of the shareholders generally. So for that reason, the internal rate of return is simply the rate at which the inflows from the project will be reinvested. And so the rationale behind that is that, in a simple language, if the internal rate of return is greater than the entity's cost of capital, if the internal rate of return is greater than the entity's cost of capital, then what is going to be happening here is that we will accept what? The project. The reason is that it means that the inflows coming from the project, we will reinvest it at that higher rate, and so we will make more returns than our cost of capital. And the reverse is true. If our break-even rate is less than the cost of capital of the project, it means that the inflow of the project, when it is reinvested, certainly we are going to be making losses, and hence we reject the project. So like I said, the internal rate of return is like the rate at which the cash inflows from the project is reinvested. Now, in advanced financial management or in advanced corporate finance, which is not in your syllabus in management accounting, there is what is called the modified internal rate of return, which that is MIRR, which takes this whole internal rate of return and brings in a realistic computation. But we're not going to get there because that is not that is outside our syllabus. So the idea here is that what is the rate at which when we reinvest the cash flows of the project, we will get more returns. Another school of thought is that the internal rate of return is simply the rate at which the NPV of the project will be zero. Okay, is the rate at which NPV of the project is the rate at which NPV of the project is nil or zero. What does that mean? That is why it is also referred to as what? The break-even rate. That is why we call it also as the break-even rate. Because if you remember from break-even analysis, it is where the total revenue is equal to what? The total cost. So the rate at which the NPV of the project is nil, is zero, is the internal rate of return, is also the break-even rate. So how do we put this in perspective? The formula of the internal or for the internal rate of return is pretty simple. It is going to be A plus NPV of A divided by NPV of B minus NPV A and then B minus A, all percent. Here, very broad formula there. Now, remember these formulas are not going to be given to you. Sorry, I messed that up. It's rather NPV A minus B. These formulas will not be given to you, so you have to know them off head. Okay? They will not be given to you, but you must know them off head. And that is very important when it comes to dealing with these things. So that is our rate. Now, stay with me carefully. You can see that it means we are going to be calculating two NPVs. So the way we deal with this is that usually the examiner will throw a blank check to us. In other words, when the examiner wants us to calculate the internal rate of return of the project, he will just say calculate the internal rate of return or the break-even rate. In such circumstances, what do? You're going to be doing what we call a trial and error. So in IRR, we use a trial and error approach. Please stay with me carefully. The information will be given to us. So the first NPV that we calculate, we can discount the cash flows at 10%. We can discount the cash flows at 10%. So because it's a trial and error, you don't know which rate to use. So it's always advisable to start with what? 10%. So we start with 10%. Now, if you do the NPV of the project and it is positive like that, what it's telling us generally is that the ratio or the discounted rate that you used, it's small. So in the next NPV, so where we do this and it is positive, our NPV is positive, it means that the rate 10% we used was small. So in the next NPV, we will increase the rate. Let's take that again. We are going to be doing a trial and error approach. So if you are doing a trial and error, what does that mean? It means that you start with 10%. So your discounting factor is going to be 10%. Now, if your discounting factor is 10%, what does that mean? It means that when you calculate and your NPV, it's positive, it means that the rate you used was too small. So in the next NPV, you are going to be what? Increasing that. Now, it's at your own pace. You can increase it to whatever level you want to increase it at. It's your own swag. It's your own call. But if you do that first scenario and you get a negative NPV, it tells you that the rate is too high. So in the next NPV that you are going to be doing, you are going to reduce the rate. That is the idea about calculation of the net of the internal rate of return. That is how we deal with calculation of the internal rate of return. Give me a moment. Someone coming up. Let me see. Oh, Rebecca. Okay. Any questions, you raise your hand, we bring you up, or you put it in the chat for us. So in the exam hall, you're going to go with trial and error and start with 10%. Now, if it happens that you did that 10%, stay with me carefully. If it happens that you do that 10% for the first time and the NPV of the project is 0 or nil, then you end there. It simply means that the IRR, that is the internal rate of return, is 10%. It's rare for you to get that scenario, but it could happen. It could happen. So if you do the first NPV schedule like that and you get 0, that means your IRR is going to be what? 10%. But 99.9% of the time, you're not going to get that luxury. So you have to go through the hoops like that in that regard. That is how we deal with internal rate of return. So everything that I've said, it's available here. So if NPV of the project is positive, in the second rate, we use a greater rate. Why? Because the first one was too small. So that is why we said increase it. Then if you do the calculation and it is negative, it means the rate was too high. So in the second one, you use what? A lesser rate. You use a lesser rate. So that is the idea about how we deal with internal rate of return. Now, let's contextualize our discussion and see exactly what we are supposed to do in the context of Pink score. So we're going to be using Pink score as a guinea pig to just do our calculations here. So go back. We did the first one at a rate of 12%, right? And it gave us a positive NPV of 33347. So what does that mean? What was the rule we established? We said if the NPV is positive, it means the rate is too low. So what do? We increase it. So we're going to go into another schedule. But the good news is that in the second one, you don't do the entire work. All you need is the net cash flows. So I'm going to just pick the net cash flows because that's what we need. That's all you need. Then you apply the rate on it. Here we go. So we're going to do the second NPV. Now, something I didn't say here, let me say that once. The B is the rate, the higher rate. Okay. The A is the lower rate. Take note of that very well. The B is the higher rate. The A is the lower rate. For that reason, NPV A is the NPV of the lower rate. NPV B is the NPV of what? The higher rate. Sounds good? Let's go. Now, so in the first scenario, we had a positive. It means in our next schedule, we have to increase it. So the question we ask ourselves is, increase to what rate? We use 12%. So let's increase to what? What rate should we increase? It's discretionary. We can use any rate. Remember, it should be something that you can read on the table so you don't have to do the calculation and waste your time. Does that make sense? It should be something that you can simply read on the table. So we were using 12 earlier. Now let's use what? Maybe let's use, I'm coming. On our discount table, we can read 20. So maybe let's increase it to 20 and read that on the discount factor table. It's discretionary. We just need an increase. We just need that increase. So it could be 15. Isaac said 15. It could be 20. It could be 17. It could be, but like I said, it should be something that you can easily read on the table so you don't have to, spend a lot of time to calculate anything. So at 20, these are the rates respectively. Remember, for the discount factor table, it will be given to you. So this is the present value table. Last week, I explained to you that we have the present value table and we have the annuity table. The present value table is what we are excited about. So let's bring in the rates. Don't worry, I only need them. Year 0, sorry, I didn't put the year up. 0, 1, 2, 3, 4. Let's go. Year 0 is always 1.00. Year 1, 0.8333. No, sorry. Just this. 0.694, 0.579, 0.482. So let's multiply up. Let's get a present value respectively. Remember, year 0 will still be the negative 20,000. So don't bother yourself on that. Fastest son, please multiply for me. Let me see the answers that we're going to be getting in the context of this one. What do I have here? Year 1 or anything. Who is punching and giving me some answers? $90.36 for what? 90.36 for what? 30. So this is our present values. So we could add it up to get a net present value. And that is a positive of 25,17157. How are you getting 157? How are you getting 154? Isaac.
It's 157.
So 157. Now, the goal of the second thing is not to make it to go to 0 or to make it to be negative. Because there are some people who think that, oh, when we do the second one, it should be negative. No, that's not the goal. The goal is to increase the rate, period. So the second thing could still be positive, but you realize that this positive is below the earlier positive we had. Okay, because the first positive was this figure, 33. Now, when we discount it using the higher rate, it's now 25. That's the goal. Does that make sense? The goal is to get a lower rate. The goal is not to take it to negative. The goal is not to make it 0. The goal is just to have a lower NPV at that higher discounted factor. So what do we have here? Pretty simple. So in the context of this question, our A, which is the lower rate, is the 12%. B, which is the higher rate, 20%. NPV at the lower rate was positive 33,347. NPV at the higher rate is still positive 25,157. The reason I'm emphasizing on this is that some people end up making this formula plus with the mind that the NPVB will always be negative, so that nege becomes poor. But please, it is not about, that is not our goal. Our goal is not to make the NPV to be negative so that nege will become poor. No, the goal is to use a higher discounting factor to arrive at a lower NPV. That's the goal. We are not here to get zero. We are not here to get negative. So now that we have these, we can substitute that into the formula, sorry. So IRR will be A, which is 12%, plus NPV of A, 33,347, divided by 33,347, minus 25,157. If the NPVB was negative, then it should have been nege poor. But in our context, it cannot be poor. And that is going to be 20 minus 12%. So you punch it out. Be careful the way you punch out, because it's a board mass situation. So you work what is in the bracket. Sorry, I did multiplication here. It's a board mass situation. So what is in the bracket will multiply the fraction, then the results will be added to the 12, then we get our answer. Okay, so you can punch that out. If you have a good calculator, you could do that out generally. Plus fraction 33. Okay, let me introduce a bracket here. 33,347 over 33,347 minus 25,157. We close the bracket. That's going to be times 0.2 minus 0.12. Okay. Times 100. Sorry, I messed it up. 33,347 over 33,347 minus 25,157. And that gives us this particular figure. Multiply by 0.2 minus 0.12. Then that result will be added to 12. And I'm getting 44.6%. You can confirm that. 44.6%. 44.6%. You can confirm that as well. 44.65. Okay, so on YouTube, Bontley has confirmed that. So that is the idea about the internal rate of return. Now, decision rule. Remember, like I tell you always, we don't just do the calculation. So since the internal rate of return is greater than the entities, is greater than Pink's, you just want to contextualize Pink's cost of capital, the project should be undertaken. Sounds good? The project should be undertaken or accepted. That is the idea about IRR. Again, the goal is not to make the NPV to be negative. That's not the goal. The goal is to apply the principle by increasing the rate. That is the goal. That is the goal. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for me. For those of you who are joining us on YouTube, give us a thumbs up. If there are any questions, you put it in the chat as well for us as we go together. Okay, so that is IRR. Very sweet, simple, straight to the point, right? No miracle, no cause for alarm, nothing giddy-giddy like that. Nothing giddy-giddy like that. But let's get a little bit, serious here. And let's look at a question here. This question, we will make it available on the portal for you, but it is the August 2022 ICAG Management Accounting question 2. This was the question that came last semester for investment appraisal. 15 marks for investment appraisal, 15 marks, August 2022. Okay, you can download it on the ICA website, or we will make it available on the portal under this video for you as well. Or you can just take a screenshot and run with me if you want to run along as well in that regard. It's an interesting question, and the requirement is pretty simple. I think it's question 4 rather, not question 2, it's question 4. So for 15 marks, the examiner said, using break-even rates, and here the examiner was generous to tell you what the heck that is about. Internal rate or return, internal rate of return. Advise whether TL should acquire the new plant. I want you to stay with me carefully with this question because it's an interesting one, has a lot of storage in it, and we're going to try as much as possible to build a story in our discussion. So let's see. TL. Let's read the story. Tanko Limited, TL, is engaged in the manufacturing and sale of a single product, GG. The existing manufacturing plant is being operated at full capacity of 6,000 units per annum. But the production is not efficient to meet the growing demand of GG. TL is considering replacing its existing plant with a new Japanese plant. So this is the decision they want to make. They want to replace the existing plant. The production capacity of the new plant will be 50% more than the existing capacity. The board of TL considers this expansion as a high-risk investment and requires a minimum expected rate of return of 15%. Did you hear that? So this is the expected cost of capital of the company. Remember the rule we established under internal rate of return. We said we will compare the internal rate of return with the entity's cost of capital. And if it happens that the entity's cost of capital is greater than the internal rate of return, then we reject the project. But if the internal rate of return is rather greater than the cost of capital of the entity, then we accept the project. So the minimum decision or the minimum rate that the entity is going to be accepting is 15%. That's very important. So let's go. To assess the viability of this decision, the following information has been gathered. The following information has been gathered. The purchase cost and installation cost of the new plant will amount to 3.14 million Ghana cedi and 0.45 million Ghana cedi, respectively. Will amount to, so this is the cost of the asset. So we're going to start with some workings to take some free marks as soon as possible. You know, I'm interested in free marks. So workings 1, let's try to get an initial cost. And sorry, no, not this. Oh, I just want to swipe. The data is given in million. So we would want to tell the examiner that sometimes the million will mess us up a little bit. So we want to tell the examiner that all workings will be to the nearest 1,000 Ghana cedi. Okay, so we're going to work with 3 zeros up. So all workings in, hey, Ghana cedi. Akwa we kra uhadrin. In Ghana cedi. In Ghana cedi. So let's put it up here. 1, 2, 3. Now, the reason that we would want to work 3 zeros up usually will be to reduce the length of work that we are supposed to do so that we can work to the nearest 1,000 and go as fast as possible. The examiner is not going to punish you. Once you've stated to the examiner that, hey, this is how I'm working, he will understand. Okay, so no P. So purchases cost, let's bring that up. It's relevant because it is yet to be incurred. So the purchase cost, that is given to us as 3.14, and that'll be 314. 3.14, like this. Then installation cost, that is 0.45, that is 450,000. So that'll be 450. Okay. That'll be 450. Then let's continue to read. So we finished with the note 1. Let's continue to read to see what else we got in relation to the information we have available. Note 2. The supplier would send a team of engineers to Ghana for final inspection of the plant. Who is this? Let's go. For final inspection of the plants before commissioning at a cost of 120,000. 50% of this cost will be borne by TL. Now remember, before commissioning, it means before the machine will be operational, we have to pay this cost. So this will be part of the initial investment or the initial cost that we need on this particular asset. So the inspection cost will be coming in. What are they coming to do? They said will be sent to inspect. Okay. So inspection cost. Remember, we are paying only half of that. So 50% of 120,000. And that's going to be 60. Remember, we are working 3 zeros up. So that's going to be 60. That's going to be 60. So that is a note 2. We are done. Any questions, you raise your hand, we bring you up, or you put it in the chat. Note 3. As a result of installation of the new plant, fixed costs other than depreciation will increase by 0.3 million per annum. That is a relevant cost. We will bring it on the face of the NPV schedule. Fixed cost other than depreciation, depreciation is a non-cash item. So the examiner is saying that fixed cost other than depreciation would increase. So that is an incremental cost. So we have to consider it as relevant. And that will come directly on the face of our NPV schedule. When we get there, we're going to be bringing it up. Okay, so there is no workings we are supposed to do about fixed cost. It's a clean sheet for us. We'll pick it up and then we go away. Okay. Note IV. The existing plant has an estimated life of 10 years, and the existing plant has an estimated life of 10 years, and it would Sorry, it has been used for the last 6 years. We don't care about that really. The machine supplier has offered to purchase the existing plant immediately at 1.6. That is a relevant cash flow for us. That's a relevant cash flow. So that is a relevant inflow for us at the commencement of the project. So again, this will come on the face of our financial statement. It's a relevant cash flow, will come in year 0 because it says immediately, now. And we've established that immediately or now means year 0. So in year 0, this 1.6 will be coming up. Will be coming up. It's a relevant cash flow. We're going to be bringing it. Note V. During the latest year, 6,000 units were sold at a selling price of $550 per unit. Please stay with me carefully. 6,000 units were sold at a selling price of $550 per unit. Variable manufacturing costs are 450 Ghana cedi per unit. TL expects to increase sales volume by 25% in the first year. So something is beginning to happen. Something is beginning to happen. So working stew. Sales volume. The examiner is beginning to tell us a story about the sales volume. Now, the current 6,000 and the price 550, for now, we don't care about it. But the fact that they expect sales should go up by 25% in the first year after installation, that's a relevant information for us. So we don't know how long the project is. So maybe let's continue to read. We'll get to know the length of the project. Thereafter, the sales will increase by 4% per annum. Selling price and variable manufacturing cost will increase by 5% per annum. Wow. Interesting. Interesting. So how are we going to structure this out? I'm going to structure this out in a very simple way. Give me a moment. Someone coming up. I'm trying to see who the heck that is. Okay. So we want to keep our work very simple. So we need a sales volume workings. We don't know how long the project is. So we're going to go to workings 3. And we're going to deal with issues relating to the selling price and then the variable cost, respectively. I want to work it out separately, and then we'll put the two together. So selling price. Then I'm going to have variable cost here. Then I'm going to put the two together in a moment. Let's go. Oh, we just need to go back. So selling price and variable cost will grow by 5%. The new plant will be depreciated using straight line basis. We don't care about the depreciation because depreciation is a non-cash item. So this information is useless to us. It's useless. Depreciation is a non-cash item. We don't need it. The residual value of the plant at the end of its useful life of 4 years is estimated to be 450. That is relevant. So now we know the project is 4%. Oh, sorry, it's 4 years. Once we know the project is 4 years, we can set it out. So I'm going to put current here, year 1, year 2, year 3, year 4. Please stay with me carefully. We are looking at the sales. Currently, the sales of the company is 6,000. That's the current position. And the examiner said, let's go back and read the language. TL expects to increase sales volume by 25% in the first year after installation. Okay, so in year 1, what will be the sales volume? We apply the Fisher concept. That will be 1 plus 0.25 times the 6,000. So let's punch that out. So the sales volume for year 1 will be 6,000 by 1.25. And that's going to be 7,500. 7,500. Then let's go back and go and read. It says, thereafter, the sales volume will increase by 4% per annum. So from here, the sales volume will increase by 4%. So we're going to do 1.04 exponent 1, 1.04 exponent 2, 1.04 exponent 3. I hope you are following the trick. So 7,500 times 1.04. That gives me 7,800 times 1.04. That gave me 8112 times 1.04. That gives me 8436. I could do 8437 though. You can confirm that. So this is our incremental sales volume that we're going to be using for our NPV schedule. Any questions, you raise your hand, we bring you up, or you put it in the chat for us. So that is the idea about that. That's the idea about that. Now, I want to let the examiner know that we want to keep it a little bit simple. So selling price also, we're going to bring in current. Then I'm going to bring in the same positions we had here. Year 1, year 2, year 3, year 4. So selling price per unit. What was the current selling price? Let's go pick it up. We are told that it was sold at 550. Okay, 550. That's the current selling price, 550. That's in Ghana City. But how is selling price increasing? The examiner said selling price and variable manufacturing cost is increasing by 5%. So we'll do 1.05 exponent 1 here, 1.05 exponent 2, 1.05 exponent 3, 1.05 exponent 4. Does that make sense? So we apply. So 550 times 1.05, I'm getting 5778 if I want to. Sorry. 578 times 1.05. I get 606. There is something behind that, but I could work to the nearest Ghana city. Then times that, and that will give me 637 approximately. Then times the same answer, that'll be 669, something like that. So these are my selling prices respectively. You can punch that out. We could also decide to work to 2 decimal places for the per units, so that when you are multiplying it by the production units, you will do the approximation there. Okay? Or you can decide to work to the nearest and round it up generally. So sometimes the reason I'm doing this is that in the first example, Pink Score, we were working to 2 decimal places. In the context here, we are working to the nearest Ghana city in that regard. So there will be variants, or our answers will vary depending on what basis that we are using, but definitely it wouldn't be far from the final answer that is supposed to be derived generally. So that is our selling prices respectively for the period under review. Then let's bring in the manufacturing variable cost. Manufacturing variable cost, we bring that up. So manufacturing variable cost will work in the same fashion, I think so, because it is also increasing by 5%. All right, so it will work in the same fashion. So we bring in the current variable cost, and that is 450. So we raise the bar on that, 450 by 1.05. I'm getting 472.5. Maybe we could be 473 by 1.05. That'll be 496 by 1.05. That'll be 521 by that'll be 547. So that is our variable cost per unit also, respectively. That's our variable cost per unit also, respectively. Now, you know, we need to multiply by the units so that we can get our selling prices and then manufacturing variable cost. Then we can get our contribution and go ahead in that regard. But there is also another alternative way that we can go. We can end up calculating the contribution per unit and then put that up on our schedule if we want to in the presentation that we're going to be setting out in our schedule in that regard. But I want to go with a standard approach. So I would just bring in the sales unit and multiply them over, then we go away. So sales volume, which is from working stew. Sales volume, which is from working stew. So let me bring back this a little bit down. What do we have? 75, 78, 8112, 7005, 7008, 8112, and then 8437. So we multiply these up respectively and get our sales in Ghana cedi. And we're going to have the same fashion here. 75, 78, 8112, 8437. Then we bring in the variable cost per unit. Sorry, the total manufacturing variable cost. Also in Ghana cedis, like that. So we multiply up quickly. And I'm getting 4335 here. Next one, 606 by 78. I'm getting 4726. So I can do 4727 because we are working 3 zeros up. And I'm getting 5167. I'm getting 5644. So that is our sales respectively. Bring in the variable cost. 437,7500. 35. 48 496 by 7800 3869 521 by 8112 4226 547 by 8437 4615. So that is our sales and then the manufacturing variable costs, respectively. That's our sales and manufacturing variable cost, respectively. So the next thing we're now going to have is to find out in relation to, find out in relation to the schedule itself. So now we've finished with the various workings. The next thing is to prepare the schedule itself. Remember, in the context of this question, there was no tax, there was no capital allowance situation. If there were, we would do the calculations and bring them up in that regard. So there was no tax, so we don't have any headache on that. So let's now prepare the NPV schedule. Sorry. Net present value schedule. So the asset has a life of 4 years, or the project has a life of 4 years. So you're going to have the years here. That's going to be 0, 1, 2, 3, 4. We've already told the examiner we like to work 3 zeros up. That's why all our figures are to the nearest 1,000, like that. Then we bring in the items, sales. And that is coming in from workings 3. So we're going to be bringing in these figures respectively here. Let's see if I can fit it in. Yeah, I could. So let me clean the border lines. Let me take it back up. So that's our selling price or sales. Then we bring in the manufacturing variable cost. That's coming in from workings 4. Also there like that. Let me copy it. Come and paste it. Can it work? Yeah, it could. So let me just clean the border lines. So that's our variable cost. So we're going to less that from the selling price to get our contribution. So we subtract respectively. That's going to be 787 for our contribution. That's 858. Next one. $941. $1029. So we can less fixed cost. That was given directly in the question. We're told that fixed cost will increase by 0.3, that is 300,000. So we less 300 in either case. So I have the last one. $729,641 558 487. But that is not all. We're going to bring in the initial costs of the project. That is from workings 1. So let's go pick it up. That is the initial investment of the project. Let's add it up. That is giving me 3650. So that is an outflow. We're going to take that out. Then the next one, remember the asset that we are selling or we have had a scrap value of 350. So we bring it in. That will go to the next final year. Again, in this question, there's no working capital, so we're not going to build that into the system. Then the last note was the previous asset, which by virtue of this decision, we have to sell. Hence, we will make some returns from that particular sale. And so the returns from that sale is 1.6, 1,600. That's going to be building into the system. And because they are giving us a new asset, we are buying the new one. Also, we are buying the new one and they are buying the old one. So it's like a trading. Okay, so we can call it trading value of the existing asset, and that is 1,600. And that's an inflow. So it's going to be positive at the year 0 now because they use the word immediately. Okay, they use the word immediately. Okay, so I think these were the cash flows. Like we said earlier, the plant being depreciated on a straight line basis, depreciation is a non-cash item, so we're not going to be considering it in our calculation. Okay, because depreciation is a non-cash item, so we don't consider it. So we are done. We added up to get a net cash flows. There is no tax also here, so it's a good news for us. And so year 0, 3650 plus minus 1,600. So it will be 2050, but still negative. This didn't have any effect. 847 558 641. This will be 350 plus 729. That'll be 1079 there. So now we are done. But remember, we are doing IRR. The company's cost of capital is, okay, so they said that in this question, they said that the investment should have 15%, minimum of 15%. But then the examiner is generous to give us a cost of capital of 12%. So because we have been given the cost of capital of the company, we can start with that. So the cost of capital of the company of, 12% is given. So we can start with that, and then we'll make the necessary adjustments if we have to. Assuming there was nothing like that, then that is where I mentioned that we could start with what? The 10%. So discount factor at 12%. Year zero is still going to be 1.001. So let's go to the present value table, go reach 12%. And bring it up here. I just needed to write 0.893, 0.797, 0.712, 0.36, 636. Then I can remove this from here. Then we can multiply to get a present value, respectively. That's still negative 2050. But let's get the respective figures coming up. And that is 4, 3, 5, 558 by 0.797. That is 4, 4, 5, 641 times 0.712. I'm getting 461. 1079 by 0.636. 686. So we can get a net present value. And let's add it up. 435, 445, 461, 686, minus 2050. Ooh, negative 23. So negative 23. So the NPV of this project, it's negative 23. In the context. Hello,
And so I'm getting negative 28. So.
Okay. Oh.
Year 3 is 456. Year 3, 456.
Let's see. 641 times 0.712. Right. So in that case, 435, 445, 456, 686 minus 2050. That'll be 28. So the NPV of the project is negative 28. So per our rules, we said that if the rate is negative, or the first one, when we do it and it is negative, it means the rate is too high. So in the next one, what do? We reduce it. So we do the next one, and all we need is the net cash flows. All we need is the net cash flows. So we're going to pick it up in the next one. So we bring in the periods 0, 1, 2, 3, 4. And we are reducing the rate. So we can reduce it to whatever. We can reduce it to whatever amount in that particular case. Nhyira, please, when gives scrap value, do you treat it before tax or after tax? Because I came across a solution and the scrap value was treated before tax. Scrap value doesn't have any tax implication, so you don't bring any tax on it. So it is treated after tax. Scrap value is always brought after tax because it doesn't have to have any tax implication on that. Because the tax implication of the scrap value will be dealt with in calculating the tax benefits. So you don't bring it before charging the tax again. When you do that, it has become double taxation. So scrap value always comes after tax, always comes after tax. So here we're going to use whatever, 5%. We're going to use 5% in that particular case. So let's see. Please, can we get full format of the NPV schedule? There is no format for NPV schedule. It's dependent on whatever is happening based on the question that you have available. And it is always based on the questions that we have solved. In the last week, you saw the things that we brought in that regard, and you saw the way the items that are treated. So there is no standardized format for NPV schedule. You have to bring your revenue less your variable cost, bring in your contribution. If there is incremental fixed cost, you less it. Then if there is any tax issue, you deal with the tax. After that, you bring in your scrap value, you bring in your working capital movement and all that. So it depends on the context of the question, because there are certain things that may be in the format, may be in the question, but you don't consider it, like fixed cost. Unless the fixed cost is incremental, you don't consider it, like overheads. Unless the overheads is incremental, you don't consider it. So these are the issue in relation to that. Fixed cost is a cost. It has to come before tax. Last week, you saw how we deal with it. It's about consistency. Last week, we brought fixed cost because you need the net cash flows before tax so that you can apply the tax. So you brought sales. We brought sales with less variable cost, got contribution with less fixed cost, because these fixed costs were also specific fixed costs. And so after that, we brought in the tax, and then we dealt with the issue relating to which fixed cost is a cost. It must come before tax because you have to charge the tax on the net cash flows before tax for the period under review. You have to charge the tax for the period under review. So it's the consistency in what we are doing that will tell you how the treatment is supposed to be done generally. That will tell you how the treatment is supposed to be done generally. Yes, Isaac, your hand is up.
Please, I want to ask that, assuming there was tax in the question, and this tax was to be paid in 1 year, is to be paid in 1 year in arrears, would the number of years increase to 5? And
Yes, we explained that last week.
And if it
tax
does,
is going to,
and if it does, will it affect the sales and the variable cost?
The only thing that is going to affect is the tax. It is the tax that will be shifted. And I think we explained this last week. It doesn't affect the individual items. It's only the tax that is going to be affected in that particular case. Let's see if I can get a slide. This is what we illustrated here. It doesn't affect the sales figure. The sales figure will still be under the respective years. Variable cost will still be under the respective years. Contribution will still be under the respective years. The tax, if it is 1 year in arrears, then the tax calculation is what you will be pushing to the next year. So the 5th year or the additional year that you are going to be adding will only take care of 2 things, the tax and the tax benefits.
Okay.
Because the year 1 results goes to 2, the 2 tax and tax benefits go to 3, 3 tax and tax benefits goes to 4, then in that order. So it will just affect the tax and the tax benefits, not the individual items. The individual items will still be in their respective years.
Thank you very much.
Right. So if we are using 5% here, yes, Isaac, your hand is up.
Yes, good evening. Saying so. Anytime tax is introduced, definitely you have to also get tax benefits, right?
It depends on the context of the question. If it is available that the entity enjoys tax benefits on the asset they have bought, fine. And the information will be given to you about how you have to calculate that. So if it is available in the question and how you can calculate the capital allowance, like we saw in Pink's code, the question we solved last week, then you can calculate it. But if there is no information for you to calculate the tax benefits, then there is no way you can calculate that, because there is no way you can calculate it.
So let's assume per this question, if we realize maybe there was tax element in it, without stating anything, we'd have only calculated for the tax, and that's all.
There is no tax issue in a question without information necessarily about claiming tax benefits, because if you pay tax, you have to take tax benefits. So, like I said, it depends on the context of the question. Once tax is supposed to be paid, if information is given about how capital allowance is claimed, fine. If information is not given about how capital allowance should be claimed, then we can't calculate any capital allowance, because the question must state how capital allowance is supposed to be claimed. Is it on the reducing balance? At what rate? So the information must state that. If it doesn't state, then you will get your net cash flows, calculate your tax, and then you go away. No tax benefit, no capital allowance.
Okay.
So the context of the question will direct what you are supposed to do and what you are not supposed to do. So we are reducing the rate from 5%, sorry, from 12% to 5. I told you this is about discretionary, so we can do whatever we want. So if we are going for 5, where is 5? 5 is here. Let's bring it up. Let me bring up 5. So it's discretionary. Someone will use different rates. So if it is 5, let's go. Yeah, 0 is always 1 point, so it doesn't have any impact on that. 0.952, 0.907, 0.864. Oops. And then 0.823. We good? Yep. So let's multiply up. Get our answers coming in. That's present value. And this is going to be still 20 and 50. But let's get the respective figures. 487, 0.952. Ooh. We get in 464 here. We get in 506 here. We get in 553 here. We get in 888 here. So let's get a net present value. 464, 506, 553, 888, minus 2050. Okay, we got a positive here, 361, Ghana City. And that's good. That's good for us. That's good for us. So now we have gotten our figures. As always, A is the lower rate, so 5%. NPVA will be the NPV at the lower rate, and that's 361. It's positive, remember that. B is the higher rate, which was the 12%. NPVB, we were told, gave us what? 28, right? Negative 28. So now that we have our figures, what do? We put them up. So NPV, sorry. IRR. So this is for a 15-mark question. See the workings that we have done. 15 marks. So speed and accuracy is going to be very important in the exam hall. If not, by the time you finish one question, you use 1 hour for it. So internal rate of return will be A plus NPVA. You want to write the formula down. NPVA minus NPVB, B minus A, in brackets, all squared up here. So we go. The IRR will be equal to the A is 5% here for the context of our question. Then plus NPVA 361. So here it will be minus 28. So nege will become poor in the context of this question. Into brackets 12% minus 5%. Okay, so in the context of this question, nege will become poor. So let's punch it out and let's see what we have here. 361 over 361 plus 28. I'm getting something. Multiply by into brackets 0.12 minus 0.05. I'm getting something there, plus 0.05 times 100. I'm getting 11.5%. You can confirm that. 11.5%.
Hello, sir.
Yes.
Ishi, I thought the MPVA is the first one we calculated.
That is not the rule we established. The A is the lower rate. The B is the higher rate, not the first or the second. So the A and B is not about which one did you do first or second. It's about which one is the higher rate, which one is the lower rate. So the A is always the lower discount factor and B is the higher discount factor. That's the rule. That's the rule. So not about what you did first and what you did second. It's about which one has the higher rate and the lower rate. So my answer is 11.5%. 11.5%. Now, if you check this, I think it's lower than the threshold that the company wants, 15%. So the project will be rejected because it's lower than the target of the entity. Where is it? Any questions? That's all. That is the answer. Do this and we give you 15 marks. But that English is important, so let me write it down. What was the question again? It says, advise whether the project, okay. TL Limited should reject the project as the IRR is lower or below the, what was the language the examiner made? Expected rate of return of the entity. It's below the expected rate of return of the entity. All right, that English is important than the calculations that we have done. So 11.5, there we go. Now, if you look at their solution, you realize that they used different figures, they used different rates, but they still got 11.5%. Because no matter the rate you use, however you work your way out in terms of the approximation, it will still come home to getting the final answer right. So if you look at their solution, you realize that the approximation was different. The second rate they used was different, but in the end, it's 11.5. It's 11.5. And that is the beauty of investment appraisal, especially in IRR, where it is left for, how do we call it? Discretionary, or where there is more discretion on the kind of rates that we can use. So this is it, 15 marks. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for us. So last semester, this was what students were required to do for 15 marks. Yes, Isaac, your hand is up.
Sir, please, I was thinking like just what my friend said. I was thinking the first rate was going to be A, so I tried the other way.
You said what?
I was saying that I thought the first rate that we used, that's the 12%, was automatically going to be the A.
We didn't say that when I was explaining the point. The point I explained here is that the A is the higher rate and the B is the lower rate. Where was that statement that I even made? Or okay, maybe I made the statement orally. Yeah, I made it here. This is the statement I made. I said B is the higher rate, A is the lower rate. This is what I said earlier when I was explaining the rule. So it is not about what is first, what is second. It's about which rate is higher, which rate is lower. That's the principle. That's the principle. So it's not which one you calculated first. It is which one is higher, which one is lower. The higher is always B, the lower is always A. That is one of the misconceptions people have about the IRR. That is one of the misconceptions. In addition to the fact that, oh, the denominator must always be plus because the B will always be negative, which is one misconception. Another misconception people have is that the first one will always be A, the second one will be B. No, if you follow these two misconceptions, you get Zokbo. So please follow the rules. B is the higher rate, A is the lower rate. That's
Please, can
the
we
rule.
take screenshots?
Screenshot of Ebaze.
The solution.
Okay, so you start here. Any other questions about IRR? You raise your hand, we'll bring you up, or you put it in the chat. Next slide. Next slide. Next slide. Oh, sorry, final slide, rather. Final slide. So that is a concept about internal rate of return. It's NPV and IRR is the examiner's baby girl when it comes to investment appraisal. Just like how when it comes to short-term decisions, break-even analysis is the examiner's baby girl. You know, it's the same thing. So he has brought this over and over again. That doesn't mean the other methods are not valid or are not usable. We're going to get into the other methods in a moment. for you to see as well in that regard. So this is it about that. You do this for 15 marks. Like I said, to work easy in the exam hall, one way you should go is all workings should be to the nearest 1,000. That way you don't have any point something to something, you know. And like I said, if you refer to their solution, their figures are largely different from ours. It will be different from what I presented here, but our answer will still be 11.5%. Why? Because even though we approximated, our approximation was reasonable. We worked to the nearest 1,000. So if it was below, we ignored. If it was above, we brought it. And so definitely your answer will be correct. Definitely your answer will be correct. So that is the cheat sheet, if you want to, about IRR. Okay. Let's continue. 2 more methods to go. That is the payback period and then the accounting rate of return. Please note that there are merits and demerits. I'm not going to be going into those things, but in your slide, in your book, you're going to be seeing that the document, the investment appraisal document, you're going to be seeing the merits and demerits of the methods in the book. I'm not going to be having the luxury to go through that, but you need to ensure that you know them pretty well in that regard. Okay, so YouTube, I think we're going to be wrapping up here with you guys, and we'll catch you some other time. So